Joe, thank you for joining us. So we're going to get started today on one of the third rails that we almost never talk about. And to put it all in context, we'll be politically agnostic. We're not necessarily going to root for one team or root for the other team, despite your past roles. But I want to talk about the role that politics plays in the economy today. As we are in an election year, you have some unique insights, right? I read about politics in the newspaper and watch it on TV. You've actually lived it. So I'm going to say my first question is going to be about the election. But what are some things that you believe are going to drive the election one way or the other that might not be broadly communicated?
Sure. This may be known, Matt, but in the inflation rate, the cost of living is clearly very important because people know what they spend at the grocery store, when they go out to eat, when they fill up their car. Those are costs that people experience every day, and that certainly has something recently that has bothered people. In other words, if you look at consumer confidence, consumer sentiment has been depressed, in part, I think, because inflation rates have been high. The other factor, of course, is the labor market. People also want to have a job. And the Federal Reserve, which is a central bank, its primary job is especially three roles. One is to have low and stable inflation, full employment, and actually low and stable interest rates, long-term interest rates. And the Fed has generally been successful on those, except for recently we've had a lot of inflation. And we could talk about why we've had that inflation. But you have to remember, the Fed is a creature of Congress. So even though they try and strive for political independence, they're still a creature of Congress and still accountable to these different mandates that I mentioned and have to sometimes go down a very tricky or very narrow path of operation, which I think they are at right now because you mentioned there's an election year. Rates have been steady for some time, since July of 2023. And there's speculation the Fed may cut. And of course, if the Fed cuts, the Republicans may yell. If the Fed doesn't cut, if the economy looks weak, the Democrats may yell. So it's very interesting, and the Fed's got to try to navigate these political forces.
So as we go through that, let's talk about those political forces a little bit. Inflation. Often, I've said it before, inflation is one of those things that's generally misunderstood. On one hand, for economists, it's a number on a piece of paper. And like you said, for real people, it's what does eggs and milk cost at the store. Where do you see inflation going over the next couple of years?
Sure. Economists think in terms of the inflation rate. So if the cost of eggs doubles from year 1 to 2, but then in year 2 to 3, there's no price growth. You went from basically 100% inflation rate to a 0% inflation rate. So even though the level's much higher in year 3 than it was in year 1, we think in terms of growth rates. So I think that's important to think about when economists talk about, inflation's under control. The growth has slowed. But for the normal person, the non-economist, things are still high. They think in levels, not in terms of growth rates. Having said that, in terms of the growth rate, we do think inflation will slow. In other words, we're not going to generate 6, 7, 8% increases as we did in 2022 and the early part of 23. We think growth rates will slow closer to 2%. That's not to say everything is going to be 2%. There's some things that may go up significantly in price. Some items may go down in price. We do think we're going to get to 2% inflation, in part because we do think the labor market will loosen a little bit. Wage demands will come down. We are seeing some decreasing, actually deflation of goods prices from China. We think that will weigh on goods prices. So the good news is the rate isn't going to be what it was. We may get back to 2% or close by year end, but unfortunately for the U.S. consumer, prices are still going to be a lot higher than where they were a few years ago.
So let's talk about Powell and his role for a second. And let's at first assume that Powell's doing the best he can to try to steer the economy in balance, especially we would believe right now unemployment and inflation. Lowering rates is going to help unemployment. Keeping rates high may help us fight our inflation problem. So you're kind of stuck that trying to have two tasks to do the same thing. If Powell's trying to do the best he can, what would Powell do right now?
Monetary policy is a very blunt instrument. The Fed has the funds rate. It does change its reserves. It buys and sells Treasury securities. It's either quantitative easing or quantitative tightening, as it's known. But still, policy is very blunt. To answer your question, when in doubt, do nothing. A little bit like the Hippocratic Oath with doctors, just first do no harm. So I think if you're not really sure what to do, sometimes doing nothing is what is the best option. And since July of last year, the Fed stopped raising rates. I think that was smart. The Fed, though, has talked about lowering rates. If you're more worried about the economy and how its underlying strength, as I am, you probably should be thinking of cutting rates, which the Fed is. But it's very difficult. And I'd say right now, there's probably a lot more disagreement among economists as far as what the Fed should do. There are many people now coming out and saying, look, we should keep rates high, higher for longer, because inflation may pick back up because the economy, in their mind, is still holding up pretty well. There are others saying, look, the economy maybe isn't as strong as you think it is, and you've got to be forward-looking. As Wayne Gretzky said, move to where you think the puck is going, not where it is. So in that regard, maybe they should be cutting rates. Chair Powell, has talked about cutting rates just recently as this week. It seems like the Fed still believes that 3 rate cuts are likely, most likely. I agree with that. And I think to the extent there isn't, we have an election this year, if the Fed can justify cutting, I think it's better to do it sooner than later so that they're a little bit maybe beyond reproach from the parties that may not want the Fed to cut.
Okay. So now let's put on a more cynical lens. If Powell wants to keep his job, will he do what whoever's leading the polls would want? If he thinks Trump is going to get elected president, is it in his best interest not to cut? Or if he thinks that Biden's going to be elected, is it in his best interest to cut rates?
He is going to say that he needs to look at the data and be data dependent. Look, in the past, there certainly has been evidence of a central bank chair favoring the incumbent party. That happened with Richard Nixon and Arthur Burns. And many people, even Jay Powell himself, certainly does not want to be modeled after Arthur Burns, but rather Paul Volcker. You're doing the right thing. And I'd say the Fed to this point has done a very good job in trying to be consistent. Having said that, given the fact that we operate in a political world, the Fed is a political creation, it will be very difficult for Jay Powell to hold tight on interest rates, if some believe he should, if the labor market softens. So really, it will depend on how the data evolve. If we can't get into other people's head to know what political pressures they might face. But as you know, in this very divided country we're in right now, you're going to get blamed one way or another. Unless, of course, maybe you do have this immaculate landing where the economy just continues to do well. If the economy continues to do well and the unemployment rate doesn't go up much from here and the job market continues to grow and the inflation rate continues to come down, maybe by the grace of God and good luck, which is never a bad thing to have, they don't do anything this year, and they keep rates steady, and they don't become an election issue. That'd be the best thing. The cynic in me, Matt, from being in the business a while, something will happen at some point that will upset somebody in a way that the Fed is either should be cutting and they're not, or they're cutting and they shouldn't. But it'll be interesting.
Well, to the extent you believe the economy is a major driver of who wins this election, the truth is half the country is going to blame Powell one way or the other, or the loser is likely going to blame Powell that he either did or didn't do something that hurt their chances. Unfortunately,
The Fed will probably enter into the discussion a little bit. I don't think it should, but it will, because it's a scapegoat. It just happens in markets. So we sort of need somebody to blame something on. I wish there was more personal accountability. It doesn't always happen. I know in the past when I started, why'd you lose money? The economists gave a bad forecast. So I've been on the other end of that.
Right.
It's not my fault, folks. But anyway, it does happen. But I do think, again, the timing of the Fed. So if you look at the markets, for example, the markets right now have about a 2/3 chance of a June rate cut. It'll be interesting if we move through the next few months, get to June, the Fed doesn't cut. The data are mixed. It's not clear the Fed should do anything. What did I say we should do? Well, when in doubt, don't do anything. All of a sudden, you move another 8 weeks later. Now the Fed's at the end of July, or 6 weeks later, end of July. Do they then cut rates? If they cut rates, well, it's after the Republican convention. It's right before the Democrat convention. The optics. Unfortunately, the optics could look bad. So that's where ideally, you'd want things to move in such a direction it was clear that what the Fed was doing was the economically prudent course, which is what I do believe Jay Powell and many of his colleagues want, but we never know.
Often you're asked to prognosticate markets. I'm going to ask you to a broad prognostication here. If Biden takes on a second term, who would be some of the main economic advisors, and who would be at the Fed in his administration? If Trump takes on a second term, who would be some of the names of who you think would shape economic policy for Trump?
The Biden it won't change as much, obviously, if President Biden is reelected. Janet Yellen, I'm not sure she stays on long. I don't, it's an interesting statistic. Many cabinet positions last about 18 months. In the Trump administration, I believe it was about a year on average. People wound up leaving sooner for a variety of reasons. Although Steve Mnuchin was with President Trump, Secretary Mnuchin was there for 4 years. So, there's always exceptions. But Chair Yellen, Secretary Yellen, former chair, maybe she does another 4 years. I kind of don't think so. It's not clear to me who would replace her. I'm going to guess, without naming names, maybe somebody from the private sector. She's had a long, distinguished academic career, and somebody that has a little bit different experience and perspective might suit that role quite well. Chair Powell is there through May of 26, so he doesn't change. I'm not sure, like it's Commerce and Secretary of State, those necessarily switch. So I don't think, other than Janet Yellen, I'm not sure there's going to be major changes. For President Trump, my guess is from what the press reports say, it all kind of makes sense. Kevin Hassett, former CEH, or Council Economic Advisor Chair under President Trump, I think he certainly has a possibility. Former Fed Governor Kevin Warsh, Stanford Professor John Taylor, my old boss Larry Kudlow. I don't know if Larry wants it. I always ask him stuff. He doesn't always, he sort of tells me, but I never really know. But will depend. So those may be the four people I could think of that would fill that spot. I'd be surprised if Donald Trump was reelected that they would keep Jay Powell beyond May 26th. So it would change, I think, in that regard. So those are four, I think, very capable people. If they so desired, if they wanted, they would get it. And I don't know if they want it, but I think any of them would make good choices.
Okay. In the next election cycle, regardless who's president, what are going to be some of the biggest decisions from the Oval Office that are going to impact economics going forward?
On the Trump side, the former president is very transactional. He's talked about 100% tariffs on China as a way to kind of bring them to the negotiating table, to make sure that, for example, with EVs, he doesn't want EVs to come in through Mexico and hurt the auto industry. So I do think tariffs as a negotiating tool will be front and center. I do think you will see more executive orders. You will see more potential leasing of federal lands for energy exploration and development. There'll be more of a push for shale and gas exploration. The second administration of Trump would try to make the Job Cuts and Tax Act of December 17 permanent. But the interesting thing is, it's not clear that Republicans, with now only, I believe, a one-seat majority, will be able to maintain the House. They may not maintain the House, which means that from a legislative perspective, not as much may get done, if anything, may get done. And of course, being a second term, the president really only has 2 years before those November 26 midterms kick in, and all of a sudden we begin yet another, in a funny way, we're going to start the presidential election cycle really in another 2 years almost, given the timing of it. So not as much may get done. Under a second Biden administration, I'm not clear legislatively what they're going to do. You did get the Inflation Reduction Act, you did get the Infrastructure Act, and you did get that large fiscal stimulus, which I think, by the way, did cause much of the inflation we had, but that was back in March of 21. So we did have three large pieces of legislation. We could debate about their efficacy and whether we like the policy, but he did accomplish a lot in terms of just getting legislation passed. I'm not sure what a second term exactly looks like.
Okay. So from your seat, what are some of the leading indicators that you're looking at for this next election?
The unemployment rate is probably, other than the inflation rate, which is important. If the inflation rate certainly moved down sharply in the next several months, more so than people think, that would certainly help the Democrats and Biden administration. Conversely, if inflation stayed high, it would hurt. But offsetting that is the unemployment rate. If the unemployment rate stays around 4% or lower, that's certainly going to help. People have jobs. Jobs are important. That will certainly help. Typically, the parties are voted out of office when you have high and rising inflation and high and rising unemployment. There's a lot of time, I must say, Matt, between now and the election. I think it's a very close call. It's not clear to me that who's winning. There's a long way to go. and we'll see how the economy plays out. I've been telling clients, look, if it's 4% or less, it's going to certainly favor the Democrats. If it's above 4 and closer to 5, well, certainly it's going to help the Republicans, and we'll see what happens.
And is there any chance in your mind, or how does it play out if it's not either President Trump or President Biden who's running?
That's interesting. I am kind of like a non-consensus outlier person, and certainly there are those risks. And maybe that's one of the things that gets market volatility up. Market volatility right now is extraordinarily low. You're looking at the options markets for equities, or whether it's in fixed income. Credit spreads are extraordinarily tight. That's why it gets me worried. Something will happen, and it could be, I'm thinking maybe more along the lines of geopolitical, but something may happen that changes people's perceived calculus on what happens in November, at least for a short period of time. When we've had these kind of markets, these kind of ebullient markets, we've had a roughly 30% move in round terms from where we were last October in the S&P 500, and yet we've had 1-2% correction. And the lack of volatility tends to breed complacency, and complacency oftentimes will create its own volatility. It's often becomes self-correcting. So I think it's going to be very interesting between now and November. Strap yourself in. I don't think it's going to be as quiet as it might feel right now.
Often in a lot of the jobs that we have and the people that we interact with, we're interacting with the upper level of society who are in financial institutions and who are making large investment decisions. If we talk about the U.S. middle class and we think about the middle class, what are some of the economic stresses that are unique to them right now in 2024 that feel different than they were in, say, 2020?
The big thing is if you looked at median wages in real adjusted terms, they did not grow from really very little from 2000 to 2016. And that's what President Trump effectively ran on that platform, that whether it was Republicans or Democrats, for about 16 years, we had really poor growth in real wages. And we really had very little increase in living standards for the median household, the average folk, if you will. And under President Trump, the first 3 years were very good, where you saw across the board income gains across all different demographic and race groups. Very, very, very important. And I would argue the fact that we have had some improvement recently, which is great. Real wages are positive. That perhaps has come against the backdrop of significant debt. But I think for many people, it's sort of like people live paycheck to paycheck. And I think the stress is, how do you pay your bills? How do you make that next cost? We know people have very little savings from various surveys. God forbid there's an emergency or they need rainy day funds. They don't have a lot to draw on. Our work has shown all the pandemic-related excess savings is gone, and I think that's someone like former President Trump got into office. He sort of tapped into an area of the economy that is certainly hurting, that us perhaps in financial services don't always pay attention to. It's interesting, we're looking out over the west side here, and there's a famous New Yorker cartoon that looks from New York's vantage point out to California. And New York is like high and rising, and you look out to the rest of the country, and it's really small. And I think sometimes we are lucky, but don't really appreciate some of the average everyday stresses of what the cost of living is for people, and the insecurities and their ability to meet needs for their families and their children, et cetera.
Well, it's interesting. We talk about wage growth, real wage growth growing. And then what you hit on just a little bit, and we talked about it earlier, and that is when interest rates for the average person in the world, they're most affected by interest rates once they touch a mortgage. And mortgage rates are incredibly high. So the cost to buy a house now has skyrocketed for
That's
folks.
right.
Which also historically has been one of the big ways to build wealth. But high interest rates are working against building wealth at the time too. So as we kind of transition onto interest rates, what's your prediction for interest rates? And less about a prediction, what are the things that are going to move interest rates either strongly positively right now or strongly negatively?
You mentioned housing, and hiring in housing has been very strong. And to me, that has to stop, or at least slow, if not reverse a bit, because you said rates are high. Yes, they're low relative to where they were 20 years ago, or I should say that. They're low relative to where they were 30 years ago. But if you look at like average household borrowing rates, which include mortgages, auto loans, credit cards, personal loans, they're at about a 2-decade high. So even though rates have come down from close to 8% to 7, maybe slightly below, depending on where you are and how much money, et cetera, you put down, those rates are high. We also know housing affordability is low. Single family housing affordability is close to an all-time low. Affordability is a function of three things: the mortgage rate, which you highlight, the home price, and income. Income has generally been pretty good. It's been not strong enough, generally speaking, relative to where inflation is, but the income numbers look okay. If income picks up, the Fed probably hikes more, so that means higher mortgage rates. So that means the only way you're probably going to get housing affordability to improve from here, Matt, is if either rates come down a lot and or home prices drop. Well, if home prices drop, you probably have a recession, because that's one of the biggest items people have, as you said, wealth.
Right.
And then rates fall. So you might get affordability up if we actually have a downturn. Of course, people don't want a downturn. I think what winds up happening is the housing market probably stays a bit frozen longer than it's supposed to. And I do worry, because those rates are high, unless they come down dramatically. And I do think, to answer your question, I do think rates can move a little bit lower here. When I look at the U.S., I think, yes, fiscally there's a lot of problems, rates should be higher, but there are many other countries in Europe and elsewhere that have much worse fiscal situation than the U.S. in terms of worse demographics and higher deficits. If you look at many of the European countries, Italy, Spain, Greece, Portugal, even the UK, their long-term rates are actually lower than the U.S. So I do think rates can come down here, but for housing, mortgage rates are a problem. So what we've seen is basically the housing market, basically frozen in a lot of places. Not a lot of home sales, pending home sales very soft, construction activity slowing, starting to see a backlog of housing activity come down. So I don't, again, this is sort of, now I'm getting into the more negative aspects of the economy, sort of my bias why the Fed is supposed to cut, because I don't think the economy is as robust as it might appear, or at least where I see the trend. I don't think the trend is going to be as strong as what we've seen, because important cyclical areas of the economy aren't going to get that, maybe are not going to get that interest rate relief they need.
So we're painting a muddled picture. We're painting a picture to say, hey, the economy has some good things to it right now. Labor rates, by and large, look good. Although what I'm hearing you say is that we're on shaky footing in the economy. And if you were Jay Powell, you probably would be cutting rates because you're worried about some of these issues that are hitting especially the middle class right now.
I would cut rates and sort of couch it as a stitch in time saves 9. I talked to you, I'm Jay Powell, I'm saying, look, I told folks, if he goes before Congress and he testifies, I mentioned back in December that I thought inflation was going to move lower. We're moving in that direction. Economy looks a little bit more wobbly today than maybe we were a few months ago, let's say, assuming the data come out the way I expect. And I went on 60 Minutes, as my predecessor Ben Bernanke did in March of 2009, talked about green shoots. Jay Powell talked about, look, inflation's generally moving in the direction we want. And therefore, I made a compelling and persuasive and consistent case to cut rates. And then cut rates and see what happens.
Right.
And then, you cut in June, it's not going to be as big an issue. You wait till September or after the election, you can see how people are going to get upset by that. And of course, with social media, everybody now has a bully pulpit or has a microphone that they can comment. And you could see it getting a little bit potentially messy. So I'd like to see the data. I guess what we'd root for is the data just being weak enough to justify a cut, and then we see what happens.
Let's see what
Whether we get there, who knows? Maybe, we'll see.
So what I think is interesting, and what I always enjoy in talking to you, is I look at the entire political system as almost TV characters, right? They're not real people. But when I talk to you, I'm reminded they're actually real people with real egos and real motivations. And just because you fall on one side of the political aisle doesn't mean you actually agree with everyone else who falls on that same side of the political aisle.
Right.
In doing that, I'm going to set up a question here because you mentioned Burns and Volcker. How much of, if any, do you think Powell is motivated by history? How much would he be motivated to say, hey, history did not look kindly on Burns once inflation runs away, but it did look kindly on a Volcker who just jacks rates up until he kills inflation?
But as you're asking me this question, I was thinking about, politics make strange bedfellows, the old famous expression. Jay Powell, my guess is from things he said, that he definitely is in the Paul Volcker vein, does not want to be Arthur Roken. However, in the old days, there were a lot more Fed dissents. And people may not know this, but Paul Volcker, one of the reasons he left, if not the main reason why he left in '87, he was replaced by Alan Greenspan, is he was outvoted on an interest rate decision in July of '87. And, you've got everything unfortunately has become political, and you've got 4 appointees that the president appointed, the current president appointed, and I don't know what those background conversations are. I mean, I think the economy is weak. If other people are saying things are weak, and does Jay Powell want to dissent? There have been very few dissents. There were only, since I believe it was 92 or 93. Last time we had 2 dissents from a governor. It was Governor Larry Lindsey and Governor Wayne Angell, I believe. This was like 30-something years ago. By the way, then you didn't even know it until you got the FOMC minutes, like weeks later. So why I say this, because we're in a world now where there might be a lot of pressure for people who actually think the Fed should be cutting rates. And he may want to have a Paul Volcker mindset where I don't want to take the risk of losing credibility, hurting the institution. If I ease and it's not supposed to, inflation picks up. So again, you've got to balance this. And there's a committee, there's 7 governors, of which he's one. You've got 5 voting presidents. I mean, they really try to build a consensus, which again, it'll be interesting, Matt, if between now and November, the outlook becomes more uncertain, becomes more muddled. That's a great word to use here. What does the Fed do, and how does the Fed balance those 2 things? Because yes, you want to protect the institution, but you might be able to make a very compelling case that the Fed should be cutting rates. And how's that perceived? It's not going to be easy because, as you know, economics is not an exact science. And the data is not perfect. In fact, just as an aside, if you look at the response rates, like the response rates that companies have to these surveys, since COVID, they've collapsed. Like more than half of the responses when we do our employment survey, the government has to make guesses on. They don't have as good a data as they used to because they're voluntary. People don't want to fill the surveys out. They're burdensome. They stopped doing it during COVID, many of them. So we don't really have good data either, which again, I think right now we're priced for perfection. So my message to people is that volatility will probably pick up. This isn't going to be whatever your views are politically and economically, it's going to get a little messier between now and November.
Okay, so I want to pivot a little bit to how do people like me who are outside of the political world operate? But the first question in this vein is when someone like me looks at the way the federal government is run right now, and I look at the federal debt and I look at the obligations of the government between its entitlement spending and its interest rates, if the government were a company and if I were the chief executive of that company, I would say, we have a problem. Most of our income is going to service things that are outside of where we want to grow.
Right.
Why can't the government think of its debt the same way a business would think of its debt?
The answer is you'd give your kid because the government isn't a private company and therefore it doesn't have to operate as a private company. It creates its own currency. And that's sort of that's the answer. It's not a great answer, but it's the answer. They just don't. If it was a company, it'd be out of business, basically. And what we've seen is, by the way, Republicans and Democrats spend a lot of money. This isn't, I would say arguably the Democrats have spent a lot more recently. I've calculated that, going in, we were basically spending almost 6% federal outlays per annum pre-COVID. And in the last 3 years, we spent about over $3 trillion above what that pre-COVID baseline was, which wasn't very good to begin with. And we're approaching 125% debt to GDP. CBO says it's going to go to 160, 170, Congressional Budget Office. But you talk about entitlements, and there's one bipartisan issue is neither side wants to talk about it, which tells me that if we ever fix the problem or deal with the problem, it'll be probably because of some crisis. Either the bond market will sell off, the 1980s, early 90s bond vigilantes come back where we price a huge risk premium in the long end and those rates go up, mortgage rates rise commensurately, the dollar weakens sharply. Otherwise, I'm not sure that other than a crisis, we're going to come together bipartisan, because it has to be done bipartisanly, to fix the problem.
Right.
So I think this is something to worry about. The thing is, because economics isn't an exact science, we don't know, Matt, where the tipping point is. Is it 125 debt to GDP, 150, 175, 200? We don't know.
So if I put that in terms I can understand, let's see if I get this right. Because if I make an investment in my life, I'm happy to lose money for a period of time in hopes that in the long run, I gain more money back than I invested.
Right.
The government isn't confined to some of those same short-term views of like, do they get return on the investment? And when we know that we spent too much money, we're going to figure it out when something breaks.
That is exactly correct.
And the hope is when something breaks, we will then have enough fortitude to go, hey, everybody, something broke. We should fix this.
Right. Was it Churchill maybe who said the U.S. always does the right thing after it's exhausted every other choice? It was him, right? I think.
Yeah, I think
So
so.
that's unfortunate because it's just not. I mean, it's just one of those things where it is a third rail of politics. Just reforming Social Security under Bush 43, the second Bush, effectively was a big problem in the second administration. Basically, that ended very quickly. It ended poorly, and nobody's really touched it since. Although we mentioned earlier that under Obama there was a Simpson-Bowles bipartisan commission that recommended changes that would be done in a bipartisan way, and I think the vote was 11-8, so it was in favor of what the commission's findings were, but it didn't go anywhere. And I think the minute any politician wants to touch the entitlement issue, it's basically dead on arrival if they want to get reelected. And therefore, it makes me think the cynic in me, which I'm not always cynical, but on this, I think it's going to take some type of crisis for us to get to the point to fix it.
So in my role at my company, we're thinking about, should we make new investments? Should we acquire something, hire more people, invest in a new technology? If you were the advisor to me right now, and you were trying to overlay within my investment framework a political landscape and say, hey, this is how politics should impact, Matt, what you're going to invest in going forward, what would your advice be? Should I wait to invest until the election's over? Should I get started now? Is it
So
good
I
to
would
be?
think so. One of the things I would say is you like a team, like a sports team. You always need talent, and I think one of the things is to diversify, and that might mean just as you are now, you've got offices in many different places, and trying to attract pools of talent, and I guess making decisions that where you're not making a single bet on one product in one area. My observation just on financial markets is that firms, when they wanted to go into flow businesses, for example, you want to operate these businesses ideally with the lowest fixed cost possible. But you didn't know what year, what product might be foreign exchange, it might be commodities, it might be fixed income, or more the mortgage business, or something that or the equity business that drives the revenue flow. So I would think from just financial services, more broadly speaking, you always need access to people, and where can we hire those people? New York's a great place, obviously, given the education environment, people still wanting to come here. But I think there's more opportunities now post-COVID. And then probably not making huge bets. Like AI, I think you put a little bit of money into AI and you sort of try to, what is bet may not be the right word, calculated decisions that if you're wrong, you're not gonna sink. The firm isn't gonna sink. If that makes any sense.
It does. What I find interesting in election years is that often people who have to make decisions, it's really tempting to delay anything.
Yes.
Until an election happens. And one of the concerns I always have with delay is it's not clear to me that the impact that who the president is has the actual day-to-day impact on where the country is 2 years from now as we might think.
Right.
We have a tendency, I believe, to over-index to the impact of the president.
I completely agree with you. So my advice to you would be continue to do what you're going to do, because as a first mover, if people are slow to move because of what you just said, I do think you're correct, things will change, and half the people will be happy maybe on November 6th. Probably the other half won't be unhappy, given, unfortunately, the situation we're in. But I think from a business perspective, you can't wait. You've got to make a thoughtful, calculated bet on where you think things are going. And my guess is that whoever's in office, if it's done right, it'll be successful and won't matter. But waiting isn't really an option, because you've got to grow. Growth is the name of the game. You can't sit as your competitors are going to then potentially get in front of you. You don't want that.
So one of the things I always think is interesting is in a seat like yours, you get to consume enormous amounts of data. You have access to people who are some of the most interesting thinkers in the world, who also have impacts on political decisions, on economic decisions. How do you consume that data? What are areas where you say, what do you particularly listen to that has an impact as you kind of cipher signal from noise?
Some of the smartest people I know are money managers, macro traders, and have views on rates and the markets. And the hard part is that they may I love interest rates at 9 o'clock on Monday morning, and they're long a lot of duration, thinking long rates are going to fall. On Tuesday, they could flip the position and go the other way.
Yeah.
Many of the people I deal with are very tactical decision makers. From a strategic standpoint, I don't get the sense that many they might be strategic. For example, a lot of clients now are talking about, energy and commodities being areas that were kind of unloved in the market for many years, and that you could see, kind of maybe commodity super cycle might be too strong. But what I find is that people have these strategic views of the world, but reality is, and I mentioned a very short time frame of a hedge fund manager, perhaps changing day by day, but unfortunately, with financial services, even everybody's so short-termism,
right,
that we're all going. From markets, the traders are getting marked daily, and you lose a certain amount of money, and you're going to cut a risk position. And even on the corporate side, right, the quarterly earnings it seemed to me, a disproportionate amount. Like, I'm not really sure, even though I get to talk to a lot of really, really super intelligent people, and it's challenging and it's fun to try to outguess things, I'm not sure anybody really has a good grasp of what the long-term secular forces are. And if they do, it's not clear to me how exactly you're going to make money on it.
right.
And what I found is that as brilliant as some of these people are, successful as they are, they make a lot of mistakes. And I guess what you want to do is you don't want to be consistently wrong and lose a lot of money. You want to take a lot of little losses. So you talk about your business and investing. You don't want to do something that if you're wrong, the company is at risk. That's where I think diversification, broadly speaking, is helpful. But I don't believe in magic formulas. And even though I always try to figure out, okay, who's got the hot hand and who do I want to listen to more, it's amazing how humbling markets can be and how efficient they are, and who's really successful in one regime isn't necessarily successful in the next. It's pretty fascinating. So if you just build a good business and just sort of like play for the long run and not be so short term, maybe you could do that in your spot. But that to me is important.
It feels like short-termism causes volatility, causes markets to crash, causes companies to crash. Short-termism is a disease it's hard to cure yourself from.
And this is happening now politically, right, through executive orders, because the thing is that what will change? Well, we've seen the executive orders increase significantly in scope, and that's just by edict. This is what we're going to do. And then, of course, somebody else comes in office, it changes. It's very hard to plan when that happens. Even like our tax code, it would be great, I think, if we could just have a tax code that was in place for a period of time to see whether what is said about the code is actually correct. In other words, I looked at the Tax Cuts and Jobs Act of 2017. I looked at the revenue projections that were done before that was passed, what was projected when it was passed, and realized that the numbers actually were higher. That actually raised money.
Right.
Now, my friends of a different view than I will say, well, no, it's not good. Well, but the thing is, if we're changing it every 4 years, people don't make long-term spending decisions if tax rates are always changing, which they are. It seems like we can't just leave it alone to see what happens. And I think that's also a problem.
So as a antidote to short-termism, one of the things I always enjoy in talking to you about is how well-read you are. So give me a couple books that you've read that were written before you were born. They've stood the test of time and they're still relevant today.
Extraordinary Popular Delusions and the Madness of Crowds by Charles Mackay is a great book. Even better is Reminiscences of a Stock Market Operator by Edwin LaFay. It's a fictitious Jesse Livermore character who supposedly was a trader back in the early 20th century. And it's a fascinating book because even though it talks about like the ticker tape, and you clearly know the book was written 100 years or so ago, what's fascinating about the book is in terms of the markets and psychology, nothing changes. It's just a wonderful book that I've read numerous times. It's a classic.
That's what I was looking for. Yeah.
Human nature is immutable. It doesn't change. Fear and greed.
we can make everything electronic or trade with AI, but fear and greed is still the
Fear and
ultimate
greed.
driver.
Yeah.
I'd like to talk a little bit just about your career. In general, people are always interested. When you were 15, were you thinking, you know what I want to be when I grow up is a economist and a presidential advisor?
I thought I was going to play tennis. No, I'm just kidding. I like tennis. I was captain of my high school team, but I wasn't good enough. What did I didn't really know. I didn't really know what I wanted to be. I wasn't sure. I knew I had to do well in school. My parents were school teachers, so I had to do well in school. And I remember my dad gave me great advice. He said, when you go to school, take the professor. Don't worry about what the subject matter is. A great professor will make any subject matter interesting. I sort of interested in economics. I thought it sounded interesting. I knew I would potentially get a job. My parents were educators, so they were like, don't do education. As much as you value education, we want you to be able to not struggle. And so I studied economics, but I had a really good professor. And that really kind of turned me on. And I read about the Fed. And so I wrote my undergrad thesis on the Federal Reserve and how it operated during the Volcker era. And then got hired by the New York Fed. And then from there, that was sort of started my career. And I've enjoyed macroeconomics. Is fun. It's a little bit like, I tell people it's a little bit like sports radio. Everybody, even if they're not a macroeconomist, everybody has a view on interest rates or a view on the economy. I was out at the Short Hill malls in New Jersey and the parking lot was full. Therefore, retail sales are going to be strong. The economy's booming. You know, I couldn't get a table in New York City. So everybody is an economist. And I find that, if you tell a good story, you're thoughtful, get people thinking, it's fun. And I like to think it's recession-proof because when you have recessions, then economists become even more relevant. But that's how I got into it. I just sort of kind of stumbled on it, and I got lucky. And they say if you like what you do, you never work a day in your life. So I've been lucky.
Career-wise, what's a risk you took that paid off well, and what's a risk that you took that you would go, in hindsight, I probably would not have made that decision again?
Well, working for the Trump administration was, I thought, a big risk because all my financials were actually public information at the time, and people realized the government's like, wait a minute, they didn't pay for your housing? Wait, they don't pay for your transportation? Wait, you had to pay for your business cards? What? It's service in that regard. It's really service. So that was a bit unsettling because it's something I hadn't done before. You have family and bills and expenses and being on your own, away from my kids, was difficult. And of course, during the pandemic, that wasn't easy. In terms of mistakes, I don't know. I mean, sometimes everybody always looks at everybody else. We're in a competitive business. Say, maybe I should have done that. And an old friend of mine said to me a long time ago, said, look, don't ever say what you should have done because it kind of invalidates all those decisions, both good and bad, to the time we are in present. And they sort of made you who you are. But I'd say certainly going back to the government was certainly the most scary thing, but it was also one of the most rewarding things, just in terms of being there. I would tell anybody if they have a chance, Democrat, Republican, the White House, it's a cool place. You're there. You're in the Oval Office and you look up and you see the American eagle embroidered into the ceiling, and the knobs will have the presidential seal. It's pretty cool. It's really cool. So that was neat, and that's something I'll never forget. So, but it was scary though, at the same time.
Your experience there, so that's actually really interesting that you would tell anybody if you have a chance to serve and serve that way to do it.
We need good people. We need good people, and some people that counseled me before I went certainly wouldn't work in the former administration. So you need good people. I think people know that, and they want good people to serve because the more good people you have, the better chance of better outcomes, decisions. You want competency. So if you think people are good, then they should do it.
Right.
Take the risk and do it. But it's hard because unfortunately, people also get vilified for it. Sometimes no fault of their own, other than the fact they become now part of the public domain.
It is one of the things I wish we could change, is that once you join once, you suddenly upset half the population.
Yeah, I do believe we go through cycles. I think economics and markets, we go through cycles, and the cynic, and part of the cynic says, look, things could certainly get worse, but I also think things can get better. And we've been in periods where we've had much worse situation in terms of infighting, literal fighting. So I'm an optimist in that regard. But I would say people, yes, if you have a chance to do it, serve, but also to learn, and for people in college, step outside your comfort zone, try new things, read a lot. And if you live in your objective and you're in the markets, you realize, man, it's humbling. Life is humbling, and you could be right, and all of a sudden you could be wrong. Things change, and don't be wedded to a particular view. And that relates even to politics. Sometimes, there's certain policy you may think is good, but reality, you realize after the fact, maybe it wasn't so good. And be honest with yourself and realize it.
Okay, so last topic here, and we'll hit this one briefly, but we've gone this entire discussion on domestic activity, right? Our domestic economy, our domestic politics, and there's an argument we are in one of the most fraught times internationally that we've been in a long period of time, between what's happening in the Middle East, between Ukraine, and there's tensions everywhere. How do some of those tensions play into the way you think of the domestic economy? What are the things that you go, that's noise, it's always there, and what are the things you go, hey, that's a really big concern, and that would be a trend?
The big issue, Matt, is when you've got disruption in supply. Mm-hmm. And COVID was a little bit like that, right?
Right.
Is that we had all supply chains were disrupted because we had closed, couldn't get product, and when it opened, realized you just can't turn on the economy as quickly as you'd like. And so why does that matter? Well, if you look at the oil shock back in 73, and the second one was, I believe it was 79, oil prices surged. And they surged because supply was constricted. So things that would impact the distribution of goods, energy being a very important one, which is why I highlighted, that is really kind of central. Because if that happens, that has a direct impact on mm-hmm. economic activity, the ability to source product and generate profits and revenues, et cetera. Geopolitical events generally, if you look back, let's say starting with the Cuban Missile Crisis, they tend not to have a persistent effect. They tend to be one-off events that generally have very rapid time decay. Markets react negatively, equity prices go down, short-term rates go down, flight to quality, dollar goes up, and then generally within a short period of time, markets kind of bounce mm-hmm. back up. So to me, geopolitically, barring an expansion in the war in Europe, situation in Russia, Ukraine, mm-hmm. geopolitics to me matters to the extent, at least from an economic perspective, if you have something that dislocates supply.
Right.
That would be a concern. You can't get semiconductors anymore. Things of that sort.
That is one, when I talk to my friends who are hedge fund traders or macro thinkers, they really center around Taiwan and semiconductors as one of the biggest institutional risks. But at the same time, if supply stopped coming out of China, that would be a major risk to our economy too.
Well, that's exactly right, because the U.S. is, as much as China might be a strategic adversary to us, we still depend on so much product from them. And the global economy, especially on the goods side, is very, very integrated. It's a very integrated market, and it's hard to pull that apart. Mm-hmm. And there's vested interests that are trying to keep that together, even though maybe some people don't want it to be that closely wound together, closely knit together.
Okay. Well, Joe, thank you for sitting down. Thank you for talking.
Yeah,
I appreciate the friendship.
Yeah, my pleasure, of course. Thank you. My pleasure. It was a lot of fun. Thanks for having me.
Great.